Right next to me, we have Cheryl Penny, and Cheryl is the founder and CEO of Dynasty Financial Partners, which is an integrated platform for high-end RIAs. Before founding Dynasty in 2010, Cheryl worked at Smith Barney, where he spent much of his time in the field with financial advisors, as well as running several of their wealth management business units. Next to him, we have Chris Dupuy. And Chris just recently joined Rockefeller Capital Management late last year as Chief Operating Officer for Private Wealth. He worked at Focus Financial Partners, and before that, he had a nearly 30-year career at Merrill Lynch, where he worked either as an advisor or leading advisors. And finally, we're also joined by Ryan Morfin, and Ryan is the CEO of Wentworth Management Services, which is a strategic acquirer of broker-dealers. So we have a great panel here, and we'll get started. So thank you, gentlemen. There's a catchphrase in journalism, which I know everyone here is familiar with, and it's follow the money. And when you follow the money, you'll find the story, you'll find what's happening. So let's talk about what I think is really the lifeblood of wealth management, and that's assets. And Cheryl, I'll start with you. Okay. Tell us where assets are going, where they're leaving, and what does that portend for the future of wealth management?
Thank you, Fred. Good morning, everyone, and congratulations to Anthony and the whole SALT team on the 10th anniversary. I think that's a great question to start with, and I know in the room we have people that are on the product side, technology, capital, and wealth management. So if you look at the asset flows, and Dynasty has 47 firms on the platform, RIAs, and about $35 billion of assets under management, mostly high net worth clients. On the product side, we're continuing to see strong flows in the more efficient market space. On the passive side, we're seeing significant flows into the more operationally efficient asset products like UMAs. We're seeing significant uptick in the alternative space, in particular in private equity. We're seeing a lot more interest in ESG products, as well as some technology overlays that allow customization of portfolios within the ESG space. And we're having a lot of interest coming in with qualified opportunity zone funds, and I know that we'll be spending some time over the next couple of days talking about those. In terms of the sectors, I think it's undeniable in terms of the migration and asset flows that have been going to the independent space, ultimately to the RIA space. I think a great barometer to look at that is Schwab. Schwab is the largest RIA custodian. 10 years ago, they had somewhere between 400 to 500 billion of assets on the RIA custody side. Over the last 10 years, they've grown that to 1.7 trillion. Right? So roughly 1.2 trillion of new assets over the last 10 years. That's actually as much assets as some of the wirehouses have. Right? They've onboarded that level of flow. And if you peel the onion back a little bit further, what you'll find is a lot of that is coming from breakaway advisors, about a third of it, but really 2/3 of those flows are coming from breakaway clients that the press isn't spending a lot of time talking about, where clients are ultimately deciding to get their advice separate from where products are manufactured and sold. So at this point, I think it's a movement more even than a trend, and we're seeing north of $100 billion by both Fidelity and Schwab of net new assets to the RIA custody unit over the last 4 or 5 years in a row.
So, and I'll ask this of our other panelists, where are we in that game? I'm terrible at sports analogies, but what inning are we in? Are we at the beginning of that movement? I feel like we've been writing about it for a while. But
yeah, I think we're in the beginning stages. We think there's about $3 trillion going to move in the next 24 to 36 months. And you're seeing the custodians and firms like ours staff up to absorb the volumes of the breakaway brokers. And breakaway brokers are looking for opportunities to capture value in their practice. They're looking for higher payouts, and they're looking for opportunities to have more autonomy on how they build their book of business. And so I think given the competitive dynamics facing our industry, I think it's going to only accelerate from here, and I think we're in the early innings.
Yeah, I would agree. I think second or third inning to play on that analogy. So I'm with Rockefeller Capital Management. We're indicative of some of the change going on right now because we're in the process, very early days, of building out a private wealth organization within the Rockefeller family office business that has been around now since John D. Rockefeller started it in 1882. And when Cheryl talks about the last 10 years, what's striking to me is, 10 years ago, you were already seeing this trend in terms of asset management movement out of some of the major firms and more towards independents or some of the smaller boutiques. The trade at that time for an advisor, though, was your freedom and autonomy for a step back with respect to access to technology capabilities and platform. Today, with the investments that have been made in the fintech world and the capabilities that have now been enhanced for some of the smaller different opportunities that can help an advisor deliver solutions to clients, we've actually seen that trend accelerate rather dramatically, and I think it's still very early.
Just to give you a data point, over the last 10 years, compounded annual growth of assets in the independent channel has grown by 6% versus 3% in the wirehouse space, according to Cerulli. And we think it's going to get more pronounced and gapped out as these different business models, whether it's going pure independent RIA or hybrid RIA, start to offer flexibility, because a lot of advisors have a historic mindset of not wanting to leave some of their book of business behind. And just to be clear, not every account is ready for a fee only, for service. And so we offer firms open architecture opportunities to bring their commissionable business and have their own RIA. And so we have about 600 RIAs today across the country that utilize our back office. And we're allowing them to leave the wirehouses and keep their commissionable business intact, which is a strong value proposition, because it takes, everybody's on this journey towards independence. We think some of these niche business models will accelerate that by giving more optionality to the advisor going forward.
So what is this, obviously the wirehouses are not taking this lying down. What does it look like? What does the future look like for these firms? They're evolving as well and adapting to what's happening.
I think it's on everyone's radar right now from a strategic perspective, trying to figure out, the impact to their business over the next, 5 years or so. I had dinner a couple weeks ago with the CEO of one of the largest asset managers in the world, and he said to me something that at the time struck me as fairly profound, that getting the independent movement right here in the U.S. is as important to him and his firm as China, getting China right is, right? And given, the size of this firm, it struck me that everyone's thinking about it, right? If you're a wirehouse, you're thinking about how do I play defense but also offense? Can I provide product and services and custody and capital markets, investment banking, et cetera, to the growing independent space? Massive investment coming in from the custodians, asset managers really evolving their strategy, again, following the money. And there's a lot of migration. As I said earlier, clients are choosing more and more, similar to family offices as they have for 100 years, to get their advice, separate from safe custody and separate again from where products are manufactured. But we're seeing larger and larger teams that have significant pools of assets going independent. At Dynasty, we've launched about a dozen billion-dollar-plus breakaways just in the last couple of years. And it's not slowing down, it's accelerating because that path is so worn at this point. The advisors are making more money into the mid-60s in terms of operating income in those businesses or payout. They own all the equity in the business. The technology, as was discussed earlier, has really leveled the playing field. There's a tremendous amount of capital that's available to support both organic and inorganic growth of those businesses. So I would encourage everyone here, regardless of where you are in the financial service ecosystem, make sure that part of your strategy is really looking at what's happening around the ongoing migration in the independent space.
And I think the highest segment for asset managers in terms of new assets to grow your business is in the retail capital markets. And so we've taken a few Tier 1 and Tier 2 asset management firms to do their first Reg D offerings or non-traded offerings. And by bringing these bigger teams over out of the wirehouses who are used to having access to top-tier product, the independent channels are starting to have access and kind of democratize product a bit more. And so I think the scale that's occurring today with private equity coming in, it's allowing people to have good investment opportunities in the space, but it's really accelerating the consolidation and alignment of the sector for a more institutional quality posture.
So
I would just say I look at this a little bit differently. I mean, what Ryan and Cheryl are talking about has changed, and I think everyone in this room knows the one constant in our industry is change.
Yep.
I mean, dating myself, technological change when I started was the industry moving away from Quotron. I mean, to date myself a little bit. And I think sometimes we can get ourselves in a little bit of trouble in overcomplicating things. We're not in the asset management business, we're not in the wealth management business. Ultimately, when you boil all this down, we're in the people business. This business is about advisors delivering solutions to clients, and the dramatic change we're seeing right now, in many ways fueled by technology, and how advisors are actually going to do that delivering, and how clients prefer to have it delivered to them. Ultimately what we're seeing are more choices than ever for advisors to make with respect to where they want to take their practices, and the big firms are no longer the only game in town. And in fact, I think most would agree that the strategic direction that we're seeing, sort of a defensive play there, is to homogenize and create a very similar look and feel for all advisors in all branches at these major firms. And the danger in that is that what gets lost is the individual brand and the creativity and the entrepreneurial spirit of the advisor. And so I think more than ever, as Cheryl says, it's really important to take a look around and try to determine, based on skill set and aspirations, what is the place that you want to be when you think about now versus the end of your career, the needs and expectations of your clients around what you've historically delivered to them, and what's the best model to do it. In many cases, I think advisors and clients are voting with their feet. They're working their way towards the independent space. They're working their way towards the model that I believe we're creating at Rockefeller, which is more of a boutique, high net worth and ultra high net worth shop where they can still be creative and customized, but do so with a brand behind them and support. The choices are there, and I think probably the biggest mistake an advisor can make right now is not taking a step back, do their due diligence with respect to where they are versus where they aspire to be, and then make decisions based on that whole interaction between advisor and client accordingly.
Sure. So let's move on to another, what I think is a very significant trend going on in wealth management, and that's just, and Investment News has written a lot about this, an influx of money going into asset management firms, wealth management firms, fintech companies, from outside sources. And that really is fueling innovation, I think, there. But it's fueling a lot of changes, and it comes with a trade-off. Let's talk a little bit about that. How is that reshaping the industry?
I think look, it's not surprising. Within the wealth management space, the ROA is still fairly healthy. The margins are still pretty good. Actually, the ROA hasn't come down significantly over the last, let's say, 10 years. The cost of service has gone up a little bit, which is more where the margin pressure is happening versus the ROA. But it's definitely, the space has been discovered, and we're seeing massive influx for everything from sovereign funds to family offices, private equity, strategics, large-scale RIAs that are now well-funded, that are looking to deploy assets in the space. I mean, you go back, and I helped build and run the private wealth business for Smith Barney years ago. Back then, the larger firms were insourcing so much of the technology and the infrastructure. Now that has changed a bit, where they're more open to outsourcing, and that's led to massive investments in fintech and technology, not just in the RIA space that's ultimately benefiting the banks and the wirehouses as well. It's good and bad. Those of us that are out there trying to get deals done and do acquisitions, it's very frothy right now. We're seeing 25 buyers to every one seller on assets. Valuations are very high, and while capital obviously is important, you still need the right team, the right strategy, timing, and other things matter as well. But I think the best funded, scaled firms right now are absolutely in a position to win on a disproportionate basis going forward.
So yeah, that $3 trillion of wealth management assets that's changing, it's going to happen either through M&A or war. And I say war, and I mean pricing war, and people are running to the bottom in terms of pricing to be competitive. And the only way you can survive in that model is through scale and through productivity enhancements, utilizing technology. And so it's a lot of these back office processes or compliance, automation tools that the regulators are pushing from a cybersecurity standpoint to kind of best practices around alert-driven compliance. These are checks that a lot of owner-operators don't want to continue to cut. And so they're all looking for a lifeboat as this industry accelerates towards consolidation. And private equity's here today because you can buy some of these broker dealers at least 3 or 4 times, and some of the big aggregators are valued at 10 to 12 times. So there's EBITDA multiple arbitrage in the space. RAs 4 to 5 times. You could probably see between 15 and 17 times at scale. And so there's tremendous economic opportunities from a private equity standpoint in our space, and I think that's what's driving the attention from a lot of capital allocators to pick a platform and give them a checkbook.
So do you guys think this is a long-term trend, or could that just turn around very quickly with a different environment?
Well, I think, what I'm hearing Ryan say, smart capital finds great opportunities, but you still need to execute, as Cheryl says. And, the ability to execute relies on a lot of expertise, you can only have 20 years experience in this business when you've been doing it for 20 years. There's no way around that. And so, right now I would agree there's more competitors for opportunity within the space than maybe ever before, and we're seeing, the cost of getting in go up. But it also creates great opportunity for those that are good at executing, whether that's a firm or whether that's an individual practitioner. And that's going to continue because we all look at where the wealth demographics are going, and there's a tremendous amount of money in motion, and that's only going to accelerate from one generation to the next over the next period, 10, 20, 30 years. And so being able to utilize technology as a tool to build the right type of delivery model around the expectations of that future client and the skill set of current advisors is really what everyone's striving for. You can do it in a very customized way, the way Dynasty does, or we feel one of our opportunities at Rockefeller is we've got a clean sheet of paper to be able to build that platform that's going to be technologically intuitive and really empower advisors and clients going forward. And I think that's where we're all trying to gravitate because there's an opportunity right now to distinguish yourselves given all this change.
One of the things that the capital is really important to address right now facing us in the industry is succession. Right, and whether you're in the IBD space, the RIA space, the wirehouse space, we have an aging demographic, obviously, of advisors. No one's really doing a great job of attracting new talent. That's I think, a significant issue for our business, frankly, for our industry, but also for our country. At a time when more and more Americans need financial advisors, fewer people to deliver it. That's a different topic for a different time. But I think that the capital is going to play an important role in helping to fund succession because there's going to be significant, whether it's Rockefeller or others, I think there's going to be significant winners that are acquiring some of the smaller scale RIAs where people are looking to retire, and there'll be massive capital that gets deployed in the bank and wirehouse environment as those advisors are retiring and selling their book of business back to the firms that they work for.
Sure.
So, I mean, right now we have a lot of legacy firms that are analog in nature. There's a lot of paper in their operations. And having access to capital allows you to create and build infrastructure to move to a digital platform so that there's no paper. I mean, we have a goal for 2020 to be paperless and have all of our workflows digitized. And the only way to do that is to be really fine-tuned into what's going on in fintech. And so we've strategically made an LP investment into a fund called Workbench, which is a fintech company out of New York City. And it's going to be the folks who can implement and utilize technology faster into their organization, I think, are going to be the ones that have that outperformance and growth. And that's where the advisors, we spend half of our time when we're bringing people over talking about, well, what tech do you have and how does it integrate into my practice? And that's a really important segment, and you only can really do that in a first-class way if you have access to capital.
So going a little further out on the technology scale, I mean, I think it's important in talking about wealth management to talk about some of the really big technologies like AI and blockchain. Sometimes that stuff gets dismissed as a fad, and I don't think so, but I'd be curious to hear your thoughts. Do you think it's transformative?
Yeah, look, it's transformative if you use it. I mean, we use a firm called UpLevel, where I used to have 2 guys looking at screens looking for exception reports because there's a lot of potential hacks that come through our network from the advisors or the custodians or internally. And this basically allows me to reallocate those 2 full-time tech employees to something with a higher and better use because it's machine learning that basically alerts us when the exception report comes back. And so that's getting to the nuts and bolts, but the concept is, implementing machine learning and implementing, kind of some of these future of work technologies and actually using them is the hard part. 90% of firms in our space say they want to have a machine learning or AI plan, but only 12% of them are actually implementing it today. And the only way to get started is to get your hands dirty and start making some investments in the space.
Yeah, I agree with what you're saying. When I left Focus Financial Partners last year and had a decision as to what I wanted to do next, probably the biggest factor in my decision to join Rockefeller at the time was the fact that running private wealth for Rockefeller was an old friend and colleague of mine, Chris Randazzo, who was responsible for building the technology platform first at Merrill when I was there and then for Morgan Stanley Advisors. And to me, there isn't a better forward thinker within the technology space in terms of delivering solutions and capabilities to advisors. And his ability to be able to build that with a clean sheet of paper right now, to me, that was very exciting, and that's part of our opportunity. So then you get into this whole idea of, okay, if you have this clean sheet of paper and you're ready to go execute and you want to position advisors to be able to deliver whatever the next big idea of the future is, what are you going to make your bets on and what aren't you? And that's something that we're engaged in every day right now. As we bring advisor teams on, though, part of the responsibility that we place on their plate is to think along with us, because I think we get the best ideas in terms of what are going to be the needs of the advisor of the future from advisors that are actually working with clients today. And those are the investments that we're going to continue to make. So whether it's AI or blockchain or whatever the next idea may be, I'm always going to bring that back to how is this going to impact the experience that the client feels on the other side.
Right.
I think we're still in the early innings to really know what the full impact is going to be with AI and blockchain on financial services and wealth management in general. But if you think about the three parts of wealth management, front office, middle office, back office, I do think the further you are into the back office, the more susceptible you might be to disruption or destruction with blockchain. And I think for advisors that really focus on high level of service and quality of advice, the emotional intelligence, and clients really want that advice around life events. I think that stuff is more difficult to get commoditized. But I think there's a lot of simpler things in front of us as an industry set. And if there are advisors here that we can be focused on with integrating technology within your business to make your business more operationally efficient so that you can cover more clients the way that you cover clients today. You see all the stats now in terms of the digital client experience for your client. The average American spends 7 to 8 hours a day on their phone. So if you're an advisor and you're not ultimately on that handheld device of your client, I think over the next 24 months, if you're not there, you're really putting yourself in a disadvantaged position. There's a lot of great apps that are out there. You can have kind of a digital vault that's there. There's a lot of things on the marketing side, whether it's search optimization to make sure that you bubble up to be the top on Google. There's social media marketing that it shocks me that so many advisors don't use. We just ran a campaign for a recent company that went public targeting the executives. We wrote a lot of curated content around stock option planning, diversification, simplistic tax planning, et cetera. Targeted that company, had the employees, when they logged in, ultimately sign up for an appointment with the advisor. We did this about 6 weeks ago. We've already raised $35 million of new money for the advisor from the program. The total cost of that program, $600. I mean, it's just incredible that what's out there and what's available, right? If you have people on your team, you know where to look. And I'm happy if there's advisors here that want to talk about how we do that later in the conference, grab me, and I'm happy to share some of the secret sauce, because frankly, it's quite easy to do.
Yeah, I mean, what you're talking about, to me, it's meeting client expectations, and client expectations are changing in front of us right now all the time. And the biggest threat, I believe, to the advisor at the major firm right now is that they've spent, and many of them are in this room, I see them on the roster, they've spent 20, 30 years building up a level of expectations with respect to what the value that they deliver to the client every day. And as the big firm moves away from individuality of advisor and moves more towards a homogenized type of approach towards all advisors kind of looking and feeling and doing the same things, the risk to the advisors that they're no longer able to deliver up to that level of expectations that they've established in the eyes of the client. And ultimately, that's where the decision point comes, because when the client is used to seeing something that they can no longer receive, there's going to be a break. And that's, I think, why advisors should be doing their due diligence right now.
So to Cheryl's point, I think the holy grail in our industry is being able to provide a lead for your advisor to grow AUM. And if you utilize ad tech, and I think the prior panel about Eric Schmidt's creepy line, for $3 a record, you could buy about 123 variables from the credit agencies on anybody in the room. And what that does, it allows you to micro-target, just like what happened in the last campaign, is that very nuanced micro-targeting towards potential client leads for your advisors is where this is going. And so it's firms that understand ad tech and are implementing it to the benefit of their advisors are going to keep that retention much higher than the firms that don't make those types of investments. And so you need to have a very, your CTO needs to be a CMO today, thinking from that perspective. And I think that's where some of the org charts in our industry are going to start to change, is you're going to have a lot more marketing-heavy, tech-heavy kind of org charts looking at trying to deliver some of the value that Cheryl was just talking about.
So one of the last areas that I want to touch upon, it's something that we recently had our Future of Advice Summit, and we spent a lot of time talking about how more and more key players are building platforms and positioning themselves as platforms. And they're providing a whole range of services that help advisors, but help the end client. And I'm curious, is that the way this industry is evolving? I mean, we're going to have a handful of platforms that are one-stop shop for everybody, regardless of whether you're retail or institutional or...
Yeah, I think we've moved from product sales to kind of planning sales. Now we're moving to kind of holistic private banking. And in that perspective, you have to have a vertically integrated firm. And so you can either do it, by buying it and building it, or you can rent it by being able to have an open architecture platform to bolt different pieces on quickly. And so I do see some kind of alignment going on in the industry where people are becoming, at-a-par firms, Orion firms, and all the APIs that connect into it on the back office side. On the front office side, there's people like Case and iCapital who are providing a lot of the diligence on the product side. And so you're starting to see alignment. People are picking winners and losers, and certain firms are getting more aligned. And when you have those synergies by alignment, more opportunities start to present themselves for deeper JV relationships.
Yeah,
Go ahead, Chris.
I was just going to say that when I think about where advisors are moving, kind of to your point about the future, there are so many options right now for them to choose from. And I think from a firm perspective or a platform perspective, it's really understanding who you want to be and who you want to serve and how you want to go about that. And so I know at Rockefeller, for example, within our private wealth business, it's not right for the great majority of advisors. Just like independence isn't right for a lot of advisors. And so again, it all does come back to the due diligence of understanding what you aspire to and what your strengths are and where you want to take your practice and what's the best place to do that. So I think you're right, Fred, in a sense that there will be a variety of platforms out there that will have those capabilities dependent upon who the client is, who the advisor is, and how they want to deliver those services, and ultimately that's where the choices come from. There's choices more than ever before, and I think they're very specific to skill set and style more so than ever before.
Yeah, it seems that there's definitely a bifurcation that continues to occur between advisors that want more of the employee type structure and want to work at the larger firms, and those firms are certainly doing well, and they're great for those types of advisors. And there's more advisors that are finding their way to independence. And I think when you talk about platforms for independent advisors, so Dynasty really invented the platform space for RIAs about 10 years ago when we launched the business. What I think we do effectively is we provide synthetic scale to these RIAs, right, which otherwise might have a challenge, getting access to certain managers or technology, or frankly, they don't have to go hire a ton of people, which kills the operating margin within the business. They may not need a full-time CFO or a full-time COO, right? They can kind of rent part-time for the various needs of their business from a firm like ours. So I think you're going to continue to see large-scale national RIAs. I think you're going to find RIAs with 50, 100 billion and more in assets in the coming years. And as we said at the onset, I just encourage everyone to think about a strategy, for how you're going to benefit from that migration, because it's not slowing down.
Do you think that we will see, and I'm asking this to everybody, eventually kind of the entrance of, and let's just call it a mega platform, and I'm talking about a Google or an Amazon in wealth management, and if so, how will that change everything?
We have some fintech players that own up to a third of the marketplace for their particular segment, but I would probably say that their penetration on kind of capability to generate fees hasn't been pronounced, and so I think we're in very early stages. In the technology sector, you don't always have to turn a profit right out of the gates depending on your business model, but there's still a lot of wood to chop on making these things profitable, which then make them some sustainable platforms. And so I think that there's a tremendous opportunity for fintechs to be started and to have some new entrants into the space. There's a transaction recently, the Blue Cora deal that bought First Global. I mean, that was a fintech company buying wealth management revenue for the arbitrage in the public markets. And so I think you'll see a lot more of that type of M&A. And it makes sense, to some respect, to have that vertically integrated relationship.
The short answer is yes. I think you're going to, and by the way, the biggest investors right now in blockchain are the custodians, right? I mean, they're trying to be the ones that leapfrog themselves, which is smart. I think we'd all be naive as an industry to think no. And I think we're at an inflection point where we're susceptible to massive disruption, and we should be thinking about, at the very least, from an advisor perspective, how do we evolve to more of a cyborg type environment, right, where we can tech enable our business, for more of the middle and back office function, and really free us up to have more time to focus on those life event activities for our clients.
Great.
And I would just say, I think we're already seeing it. Its name is Bank of America.
That's a good point. So listen, let's thank our panelists. I'd like to thank Cheryl Penny and Chris Dupuis and Ryan Morfin. And again, I'm Fred Gabriel with Investment News, and thank you for attending this panel.
Thank you.